Welcome to the Ellsworth Advisors monthly update for February 2026. I'm Kelly Keenan. This is Cameron Mealy. Today we'll talk about the latest economic news, discuss how our portfolio has been performing, and then kind of what our thoughts are moving forward. Cameron, why don't you kick us off?
Perfect. Thank you, Kelly. Good morning, everybody. For reference, today is Tuesday, March 10th. And Kelly, we got a lot to talk about. It seems like every month there's a new adventure to discuss. And certainly 2026, if the first 2 months have been any indication, it's going to be a heck of a year. So buckle up, folks. Really what we're looking at right now is, I think, where it's all heading to is there is a Fed meeting March 17th and 18th. A lot of what we're going to talk about what is the Fed's expectations at that meeting. I think if you asked most economists 2 weeks ago, their expectations for the Fed meeting versus their expectations today, there has been some movement. Obviously, we've had the Iran hostilities. The U.S. and Israel launched a joint strike against Iran. Those strikes continue. That has caused the Strait of Hormuz to be shut down, which has led to the energy complex being thrown out of whack, which has led to some volatility in the stock market, in the energy market. We also have the administration's tariff plan being rejected by the Supreme Court. And we have sluggish employment that we've seen over the last several months. So a lot of issues to dissect, how it plays into the economy. Obviously don't know what that's going to translate to into the stock market, other than there is going to be some volatility. So let's just jump into the numbers. And for those of you that have been watching GDP, inflation, and employment, we've had some surprises over the last couple of months. So let's start with GDP. The last 2 quarters of 2025 GDP was humming, running at historically high rates for the U.S. On February 20th, Bureau of Economic Analysis reported that according to its advance estimate, GDP in the fourth quarter increased at an annualized rate of 1.4%. So that has essentially gone from the projections of 4%, almost 5% growth 3 weeks ago by the Atlanta Fed's GDP Now model to actual first recording of 1.4%. So a dramatic slowdown in GDP. Just a big.
What's the annualized number too?
I'm sorry?
Annualized 2.2?
Annualized 2.2 for 2025. That compares to 2.8 in 2024. So if you look at 2025, we had a 0.5% decline in the first quarter, 3.8% increase in the second quarter, 4.4% increase in the third quarter, and then the 1.4% increase in the fourth quarter, which gets us to a GDP of 2.2%. Again, 2.2% is a healthy GDP for the U.S. That is, what a lot of economists consider kind of the target rate.
It's kind of a neutral rate. I mean, basically GDP is going to follow
inflation.
Inflation and population growth, and that's about where we're at.
Yeah.
It just came in a lot bumpier last year than previous years.
So let's look at first quarter GDP and the expectations. This, again, is the Atlanta Fed's GDP Now forecast model. As of March 6th, the Atlanta Fed predicted that first quarter GDP will increase at an annualized rate of 2.1%. So right there, again, at that 2%. Let's talk about the inflation numbers. The Producer Price Index. On February 27th, the Bureau of Labor Statistics reported that the Producer Price Index increased 0.5% in January. On a year-over-year basis, the index was up 2.9%. In 2024, the index increased 3.5% and 3% in 2025. So a small tick down, but really still at an elevated level. Personal Consumption Expenditure Index. On February 20th, the Bureau of Economic Analysis reported the Personal Consumption Expenditure Index increased 0.4% in December. For the 12 months ending December, the index was up 2.9%, and we should have revised numbers. Again, that was one of those numbers that has been in delay since the government shutdown. The Consumer Price Index. On January 13th, the Bureau of Labor Statistics reported the Consumer Price Index increased 0.2% in January. On a year-over-year basis, the index is up 2.4%. So inflation is still in that more elevated 2 to 3%. Again, some of this has to do with the energy complex and volatility in the market. but we continue to be in kind of a heightened inflation
Yeah, we're
environment.
stuck around 3. And if anything, recent developments in the Middle East are going to put pressure upwards on inflation. Cam referenced the Fed meeting coming up. Not sure what the street's anticipating there. I'm anticipating no
No-
change. And if anything, the thoughts of change coming, or some more further reductions coming later in the year. I'd say if anything, maybe the probability of cuts maybe got a little bit less. Depends how long the elevated energy prices remain. That'll kind of determine, okay, they going to cut or not. But, big picture, when you look at interest rates in general, the 10-year sitting around, 4.1, 4.2 has kind of been the range it's been in. It dropped down, to 4 recently with kind of a flight to dollars early in the war, but now we're right back to where we were. So logically, that makes sense for a 10-year. Short-term rates should be around 3, which they're a little bit elevated. And until a new Fed gets in there, I don't think Powell's going to do anything with rates at this point.
Yep, I agree. And then, the one counter to everything, or the one real wild card, is the employment situation.
Correct.
On March 6th, the Bureau of Labor Statistics reported that in February, the U.S. lost 92,000 jobs. This was quite a surprise to the street. Also in this report, the Bureau of Labor Statistics did write down their December projection to now a loss of 17,000 jobs. So where once we thought we had a gain in December, we now have a loss, and now we've got a loss in February. The unemployment rate still sits historically very low at 4.4%, but the job situation is concerning, whether it's immigration, whether it's AI, robotics, you name it. There certainly does seem to be some drag on employment, and that is the one thing that could cause the Fed to maybe want to cut rates to boost the economy. I still think with, as you mentioned, the Iran hostilities, energy price, the tariff situation, there's just a lot of unknown, and the market doesn't like unknown, and the Fed doesn't like unknown. They're not now, with a new Fed chairman coming in and everybody knowing that the president is in favor of cutting rates, maybe when there is that transition, you have an immediate 25 basis point cut, just for new Fed to put its stamp on the market, on its policy, on its term. But realistically, I think 2026 should be a year of the Fed kind of standing a little bit pat, unless the numbers really dictate a course of action. Because things are changing so quickly.
Yeah,
right
and
now.
on the unemployment side, I think the 5% number is where people start really getting concerned. We're below that 4.5 or 4.5-ish. So it's getting there, but it's not there yet. And until we get there, that's when I think you're going to see more drastic action taken. The jury's kind of still out there. You're seeing more. You're seeing some layoffs now, especially in the financial sector, but that's not unusual. It's part of the normal business cycle where you start to see cuts at some point. Wall Street, from a stock standpoint, obviously, well, it's not obvious, but typically cutting jobs tends to elevate stock prices. Not that we want that to happen, but you're starting to see layoffs, more recently, like I said, especially in the financial arena, and some in software and tech. AI, I think the first casualties of AI will be in tech, software, from an employment standpoint, and then in the financial services too, where, AI can add value and cut staff, is kind of what we're seeing. I think those will be the first areas affected by it.
Yeah, and unfortunately, or you're probably talking the first cuts of AI. I've seen it with some companies that we know. It tends to be lower level employees, so data entry, fielding phone calls, customer service, the stuff that can be replaced with chatbots and with automatic fields and automation in terms of elevating, initial reports of a problem up through a chain. So I think, unfortunately, it is a lot of people that are collecting information, processing information. They're going to be the first ones that are going to feel the pain.
And the productivity gains from it is going to, we're going to see that over years. Companies that are utilizing it, it'll start filtering into the balance sheets, into the cash, or into the income statements, which will be good, or should enhance earnings. But we're very early into that part of it. So it is happening. Who the benefactors are, the jury's out a little bit. We've seen the early benefactors, and now, I think that landscape's changing for us.
Definitely.
So we talked about GDP, inflation,
And jobs.
jobs. Those are the big factors that always will drive things long term. Short term, obviously, we have this government shutdown now, which hopefully will end soon. That's going to be a little bit of a drag. Tariffs, I think, that shock to the system happened last year.
There's just
and
uncertainty now on what is gonna
regardless of what
happen.
happens, I don't think it's going to be, no longer will it be so much a drag on GDP because, hey, I think a new reality, another source of income for the government, which, a lot of people could argue, we need another source of income as a
Everybody charges tariffs. I guess we
substitute
probably
for
should
VAT
too.
tax. Well, there we go. So here we have it. And those are the big things out there. But like I said, tariffs I don't think are a big issue. The short term volatility between the war, the shutdown, that's going to continue to cause the markets to be choppy. Which, speaking of which, February, not a kind of a rough month. S&P down 0.76%, Nasdaq down 3.33. So you're getting a little bit of shuffle going on in tech land, which is where the Nasdaq's heavily weighted. The Dow Jones was actually up 0.31% in the month. Russell 2000 small cap stocks up 0.8%. International stocks still had a strong month, up 4.64. That's the MSCI EAFE, and then emerging market stocks up 5.51. So still, international stocks still, have a little bit of momentum there. Part of it's, due to the dollar weakness. That I have a feeling is going to look a little bit different come next month. Year to date, S&P is now up through the end of last month was up 0.68%. Nasdaq down 2.39 through February. Dow Jones up 2.12. Small caps up 6.20 as measured by the Russell 2000. International stocks 10.11 through February. Emerging markets up 14.8. But once again, that was through the end of the month. The indexes have given up anywhere from 1.5-2% through the war, actually, through yesterday. So, there's been a little bit of pain. I saw a politician on TV the other day saying how the market's crashed. I'm like, 1%, I don't call it crash. I call that volatility, and that's kind of what we've seen. We've not seen a market crash. So, everybody has their own measuring sticks, and what a crash is. I don't see
1929 was a crash. 2008
I don't
was
see
troubled.
2% being a crash. Year to date, our portfolios have fared well, and it really comes down to, always been a focus on quality, and we've had exposure to, the Magnificent Seven, which has been driving the Nasdaq and S&P up until about 6 or 8 months ago. So we haven't felt the pain in tech land right now. Our most defensive portfolio, our dividend yield portfolio in February was up 5%. Year to date, that portfolio through the month was up 11%. Big gainers, Amgen, Bristol Myers, American Electric Power, Public Storage, Amgen up at 14, Bristol Myers up 13, AEP up 12, Public Storage up 11. Laggards, Genuine Parts down 14%. We've actually left that position. PNC down 5%. Year to date, big gainers, Chevron, Chevron up 23%, Altria up 20%, J&J up 20%, Amgen up 19%. Seeing a little theme there with your big biotech or your big pharmaceutical companies, energy companies. Laggards, Genuine Auto Parts down 3% year to date. In our growth with income portfolio, which is about 60% stock, 55 to 60% equities. For the month, up 4.5% in February, year to date up 9%. So good start there to the year. Gainers for the month, CAT, which we just added during the month. We picked up 13% since we added it in February. PepsiCo up 10.5%. EOG up 11%. Gold up 9% in February. Laggards, NVIDIA, a little challenge there, down 7.5%. Disney down 6%. For the year, ExxonMobil is our big winner, up 27%. Honeywell up 25%. Gold up 22%. J&J up 20%. Gold, I will say, did give some back here. Kind of a flight to quality, kind of some of the unique things. You buy gold as a catastrophe hedge, so to speak. But when you have a flight to the US dollar, which is also a hedge, that hurts gold prices. So you get some wonky movement there.
But the gold trade has been great for us, and I think will continue to be a solid performer.
Yeah, we're gonna stick it out there.
Especially
That's
this
for sure.
volatility.
It's gonna be volatile, so nothing moves perfectly inverse or is a perfect hedge, unfortunately. Year-to-date laggards, Visa a little challenge, down 8.75%. Disney challenge down 6.8%. NVIDIA down 5% for the year. Our appreciation with income portfolio year-to-date, or in February, up 2%. Year-to-date up 7%. Once again, your gainers: Amgen up 14%. Freeport McMoran up 13%, EOG up 11%, T-Mobile up 10%. Laggards, here we go, Meta down 10% for the month, Microsoft down 9% for the month. Moody's, which we did exit, was down 7% for the month, and Primerica down 3.6%. Year-to-date, big gainers: Lam Research, and once again, in the pharmaceutical realm. Freeport McMoran, that was up 37%. Freeport McMoran up 34% year-to-date. Kinder Morgan up 21%. Eaton up 18%. And year-to-date laggards: Microsoft down 19%. Broadcom down 8%. Eli Lilly down 2%. Our long-term price growth, 4% for the month. Year-to-date up 9.5%. Big gainers: Trinity Industries up 19%. They're a rail car manufacturer. Newmont Mining up 16%. Netflix up 15%. Merck up 12%. Laggards, First Solar down 12.5%, which was elevated energy prices. That may get a bid again. Amazon down 10%. Mida down 9.5%. Microsoft down 9%. Year-to-date, Trinity up 30%. Newmont up 30%. Rio Tinto up 24%. So miners doing well. Chevron up 23%. Once again, year-to-date laggards: First Solar down 24%. Microsoft down 19%. And Amazon down 9%. Price potential: strong year last year. Last month up 4%. So solid gain there. Year-to-date up about 10%. Once again, gainers, similar names. I mean, once again, Gold Miner, Anglo Gold, Ashanti up 38%. Vertiv, that thing's been on fire, up 37% in February, and I know we've picked up more just since the beginning of the month. Dell up 19%. Technip FMC up 19%. That's been a great holding for us in February and in general since we've held it. Laggards: Expedia down 19%. AMD down 15%. Amazon down 12%. Year-to-date, our big gainers: Vertiv, once again, up 57%. Anglo Gold, Ashanti up 50%. Technip FMC up 49%. Petrobras, which is the Brazilian oil company, up 40%. That was a nice addition early in the year. Archrock up 35%. Big laggards: Expedia down 24%. Microsoft down 19%. Amazon down 9%. And AMD down 6.5%. Small caps for the month up 2%. Year-to-date up 5.5%. So kind of, our small cap holdings tend to be, they're definitely
They're the profitable of the
yes.
small cap companies.
The companies are
which
actually
some people
making
don't
money,
like. Yes.
so they don't quite ride the narrative as strong as the broad-based small cap index. But
Who would
nice.
have thought you could punish for owning companies that make money?
Well, it happens in small caps. Big gainers in February. Harrow up 33%. Easy Corp up 24%. Douglas Dynamics up 22%. Gorman Rupp up 18%. Laggards: IBEX down 22%. Kimball, which we stepped away from, down 14%. Sixth Street Specialty Lending down 21%. We'll see how that holds up. I feel we'll be walking away from that pretty quick. Year-to-date gainers: Astronics up 49%. Easy Corp up 37%. Who knew golf carts would be so good?
It's not even golf season yet.
I know. They're all the pre-buying for new golf carts. Gorman Rupp up 35% year-to-date, and Northwest Pips up 24%. Big losers year to date: IBEX down 24%, HCI down 8%, and Radiant down 2%. So that's kind of where we stand. I think, I like the outlook longer term, or even intermediate term. I think we're in the right spots. Once again, quality fundamentals, I think, is what's really going to work in this market, and that kind of goes right in, fits right into our hand, and it's gonna be choppy. And I think the index is going to be a little challenged, especially the S&P and NASDAQ, just because they're waiting until something changes in tech land, in the Magnificent Seven, but the narratives really aren't in their favor right now.
No, they're not.
So
it's going to be a volatile year, but we're prepared for that. We're in the markets every day. We're studying that. We buy conservative portfolios. We hold on to plenty of fixed income and commodities. So feel like we've got downside protection. Obviously, if you need cash or you have a big expense coming up, let us know. And we are approaching tax season. Several of the positions that we hold throughout the years in our portfolios are public partnerships.
I wouldn't say several. I'd say a few.
A handful of companies
Yes.
that we will own in our portfolios. They're called public partnerships. So while they're public companies, they're still partnerships, which means they generate a K-1 for their tax reporting. That is very similar for our clients that'll get a 1099 from Charles Schwab that talks about their gains throughout the year in their entire portfolio. With these handful of companies that do K-1s, you will be getting a K-1 in the mail. That is something you should include in the package that you provide to your accountant. If you have any questions, if you have any concerns, if you don't understand, obviously we're here. Please feel free to give us a call.
Yeah, an important thing with the K-1s is if it's for a stock or a position that was held in your IRA or Roth IRA, they're pretty much irrelevant.
Yep.
99% of the time. In your taxable accounts, your joint accounts, your trust accounts, you'll actually see it's listed on the composite 1099. It'll say partnerships, and it'll list if there's any stocks that fall under that category. What comes to mind just recently looking at one, Sunoco Energy Transfer. It'll say on there, if it says on there, most tax preparers will catch that and know to look for it. I know Energy Transfers isn't available till next week, so there could be a little bit of delay.
Yep.
Sunoco's out. But like Cam said, you can always
Just
give us a call.
be cognizant of it.
We can shoot them to your tax guy if you need them. But if you see something come in late, document wise, good chance it's legit. But you can always reach out to us and we'll confirm it for you.
Absolutely. So we hope you have a great rest of March. We will talk to you in April. As always, thank you for the trust you've placed in Ellsworth Advisors. If you need anything, please let us know. Have a great month. Thank you.
Thank you.